Welcome to our next installment of 5 Questions With. I'm Kristen Reynolds, a partner on our Endowment Foundation practice team. I'm delighted to have with me here today Phil Nelson, our Director of Asset Allocation. Phil's going to talk with us about NEPC's 2015 actions and assumptions for clients. Hi, Phil. In the new year, where do you think investors should be focusing their attention from an asset allocation and investment perspective?
In general, after 6 years of a market rally, we think there's not a lot of low-hanging fruit in the markets these days, and we're really focusing our attention on investors, focusing on downside risk, but at the same time making sure we're all aware of our long-term goals and long-term needs to maintain risk. So in general, looking to markets where there are some relative value opportunities. In some cases that means following where central banks are stimulating. In some cases that's making adjustments within a fixed income portfolio, thinking about areas to raise more defensive allocations, but at the same time thinking about areas where taking risks such as high yield, bank loans, other more liquid credit markets. From a relative value standpoint, for clients that have the risk budget, equities over credit might be something to look to do in 2015.
Given the current market environment, should investors be more focused on strategic allocation or be more tactical in nature?
Yeah, we think investors should be focused on both. Strategic allocations are important. Investors need to maintain their return targets and have long-term objectives to meet their needs. That being said, the prospects for increased volatility in 2015 I think are certainly higher. There has a level of complacency that's crept into some of the marketplace, and opportunities to be tactical from the client level to be able to allocate assets across different asset pools is available. And we also think within underlying strategies to give discretion and have open, broad mandates for investment managers to be able to tactically allocate to pockets of value in the marketplace.
There's been divergence in global markets recently. Are there any opportunities that clients should be considering as a result?
Yeah, it's an interesting environment that we're moving into, we think, is as central banks across the globe really start to move in separate directions. Specifically, the U.S. and the Federal Reserve likely raising rates in 2015, along with United Kingdom, while on the other side we have Japan really providing significant levels of stimulus, and the prospects of a quantitative easing in Europe I think are much higher, although it's taking much longer than we'd like for them to get there. But that kind of movement we think has the possibility to inject more volatility in the marketplace. And with that kind of divergence, you're likely to see it most clearly in currency markets, and being able to opportunistically target relative value within currencies and also within global rates, we think lends itself to global macro managers. Global macro managers have really suffered over the last 4 to 5 years under kind of a broad stimulative environment, and we think coming to an environment of increased volatility between asset classes and within asset classes, there's an opportunity for strategies like global macro, GTAA, and other more broad investment mandates that can see the spectrum of different asset classes.
With the recent spike in volatility in currency markets, what are your thoughts about hedging currency exposure in portfolios?
We think it's an appropriate response to today's environment. We look at currency hedging as more of a risk reduction opportunity than a return opportunity. But looking at the marketplace today of rates in the U.S. likely rising relative to the developed world, there's certainly a fair amount of pressure for dollar strength, which would provide a significant return benefit, I think, to clients with non-U.S. allocations. But in general, we view developed market currencies as a volatility source and not necessarily a return source. And we think it's most appropriate to hedge approximately 50% of your developed market currency risk as a long-term strategic allocation.
Given the continued uncertainty around direction of rates, how should investors structure their fixed income portfolio?
Yeah, it's an interesting question. So we look at where we are in the current interest rate environment, really 30 years into an interest rate bull run. And we are constantly surprised of how much lower interest rates can go. We look at developed market rates in Japan and Germany, all below 100 basis points. and the U.S. seemingly staying at very low levels. That being said, interest rates can go lower, but at the same time, we look at the current environment and we think the most common allocation method for clients, being core bonds, doesn't quite suit, we think, the defensive allocation that's needed in this space. So one of the things that we're encouraging is to barbell your fixed income risk, barbell your duration risks. And what we mean by that is, have some sort of allocations at the near point of the duration curve. So allocations with 0 to 3 year durations that are tactical, unconstrained in nature. A lot of these are what we call unconstrained bond allocations. And at the other side of the barbell, really encouraging clients to raise allocations to long-term maturities. So long-term treasuries, treasury strips, really provide a capital-efficient allocation to provide duration exposure for clients. And we think it's a really effective method should there be any sort of shock to growth or some sort of exogenous event that surprises markets from time to time.
Thank you, Phil, for your time today. Join us next time on 5 Questions With.